Welcome to the daily update, where I'll go over the action in the market for Thursday, February 27th, and we'll see how things look for Friday, February 28th. Late day selling, breaking below the 100-day moving average. Yeah, things are pretty negative. Now, we're starting to get to that point where our list in the short term is pretty long for things that are extreme negative. And even though we're potentially going to test the 200-day moving average, we'll have to see, we're still positive in the long term. And with the long term trend system that I use, we're still quite positive that way. But we're also seeing more of this defensive posturing where we're seeing a move out of growth going back into value, which that's what the market does when it's getting more defensive. Now, we saw a little bit of a respite from that on Wednesday, but it didn't carry through into Thursday. And we're just seeing this overall shift. This is very similar to what we saw back in late 2021 into 2022. We don't know if it's actually going to develop fully into that. We might need to go down and test some more support, specifically the 200-day moving average. But yeah, we're turning more negative. We're switching out of this pro growth environment as there's more concern about the economy. There's all this uncertainty about the new changes going on with the new administration and what that's going to do on a geopolitical level, as well as have an effect on the economy. And so the market is just having some trouble, and it's now down year to date. The S&P after Thursday is now negative, going back to the beginning of 2025. The only index that's still positive is the Dow. All the other indexes are now negative. Okay, let's go back and talk about what happened. Right at the open, we did have a higher open, but we've been seeing this a lot, that the futures look pretty strong. We look like we're going to be up about maybe 0.5%, and we open right around that level, and it looks like, okay, things are going to get a little bit better. But then almost immediately after the open, we see selling. And so we did push up. We didn't quite get to R1, which incidentally was right at 6,000. And that's also been overhead resistance. So we're seeing this pivot point and resistance that's come through before coming together. It's kind of amazing how all this stuff works. And then we started declining. We went down below the daily pivot at 59.66. Then we went negative. So we dropped below the unchanged level and we got down to S1 at 59.23. And we were just really choppy. Watching this intraday, there's just swings up and down, but not really going anywhere. Somebody tries to do a little bit of buy on the dip, and then we go up a little bit, and then somebody's selling into the little bit of strength, and it was really bouncing around. And prices kind of tried to stabilize a little bit around the unchanged level, and we just chopped above and below that. But then later on, the smart money comes in, and then they decided to sell. They took prices back down below S1. Then we broke below 5,900. We got down to S2, went below that at 58.89, and we closed at the low for the day. And so that's pretty negative. We ended up being down 1.59% on above average volume, and we are negative in the short and intermediate term. We're below the 20 period moving average in the short term. We're below the 50, that's intermediate term. Now we're starting to threaten the longer intermediate term to even a little bit long term with the 100 period moving average. That had been holding up a support. Back in January, we held at that level for three closings and then came up out of that. We broke through it this time and closed below it. So that's turning things more negative. And the GDP number came out. Now, the headline number was not changed, and that was not a surprise, but there's an inflation component in there that came in stronger than expected, more than what we saw last time. And then you have unemployment claims going up, and that's showing some economic weakness. And so the market's kind of jittery right now. The big thing on Friday is going to be core PCE. That's the other big inflation report that we get each month. We'll see how the market can react to that. Can we bounce up out of this? Have we overdone it to the downside? With the smart money coming in and doing selling, maybe there's still a little bit more to go, but we're seeing this whole shift as growth is continuing to underperform value. Okay, let's go and talk about some things. I have kind of a long list here, so the text is a little bit smaller. This shift over to being more defensive, we're back to doing that. Now, on Wednesday, it looked like, okay, we were taking a little bit of rest from that. But Monday and Tuesday, we were shifting more defensive. You can go all the way back to last Friday when things really started to turn, and even into last week, where earlier on it looked like, okay, growth was outperforming value and the smart money was coming in and doing buying. That seems to be shifting more to now folks are getting into the value area of things, which, as I try to explain, is there are money managers out there who they manage mutual funds or ETFs, or they can't get into cash like you and I can. Excuse me here. They have to be fully invested all the time and they have to stay in the stock market. We've been seeing this flight to safety as money comes out of the stock market and goes into the bond market. Some mutual funds, some ETFs can't do that. They have to stay in those defined parameters that they have, that we have that flexibility to do those things. And so when they're getting more concerned about the market, then they get over to these areas that tend to hold up better if we're actually going down, or sometimes they even go up in value. So this is still going on right now. There are inflation worries that are coming out. There's growth concerns that inflation is going up, but the growth of the economy is going down. And then we have all the tariff proposals that are producing all this uncertainty, and then all this government spending. I mean, yeah, that might be what people really want to have happen, but it's like going in for surgery that you have to be cut open and things have to be removed and there's going to be pain and things can be pretty bad there for a while before they get better. And what's that going to do to things more in the short term? And then Nvidia came out with a good report. They and even looking forward, they're looking pretty strong, but they fell 8.5%. And this is the darling stock. And it's actually dropping down to the point, I believe it's below its 200-day moving average. It might, there are some stocks now, the Magnificent Seven, that are actually in bear markets. And semiconductors are really getting hit. I'll show you that chart later. And then you have a company like Nvidia that comes out and they fall 8.5%, even though their earnings report was really good and they had strong guidance going forward. And then the tariffs that, okay, Trump came out and said that, and then it's like, oh, well, he's just negotiating. But now he keeps saying, okay, these tariffs are going to kick in on March 4th, and that's in the upcoming week. That'll be on Tuesday. And then another one was announced, an additional 10% tariff for China will go into effect also next week. And then a 25% tariff, not to leave Europe out of the party here, that will probably be announced soon. And so this is causing some real upheaval. Then you had the Federal Open Mouth Committee come out and make some statements. You had Kansas City Fed President Schmid and Cleveland President Hammock and the Philadelphia President Harker. They basically all reiterated this idea that, we're not in really any hurry to cut interest rates. Now, that's not something that's new to the market, but when you have these folks doing their thing and giving speeches and interviews and talking, and they're all kind of saying the same thing, it's like, okay, uh, we're not really seeing the hope here of interest rates actually being cut, and the market didn't like that. And now we got the VIX, and I have another chart based on some research that I show from time to time. We're back above 20 with the VIX, and this is when things tend to turn more negative. And then we're below the 100 period moving average now. It had been acting as support. We fell through that in Thursday's session, and we're now negative year to date with the S&P. I mentioned that. And then we have a pretty long list in the short term and some things that we don't see on this list very often. Now, the ones that we do see quite a bit, the Stochk RSI, Williams percent R, CCI 1420, stochastics. Okay, those are usually on the list when we're negative, and they're usually on the list when we're going up and looking positive too. But now we have the rate of change going back 5 periods. We don't see that one very often. That's getting a little extreme negative. The force index, sometimes it's on the list, sometimes it's not. That's getting extreme. We're down into the -3 channel with our standard deviations chart. And that's because we've been going down pretty fast. And then the boom indicator, we're getting kind of far away to the downside from the 20 period moving average. And then the RSI, the short term one based on 9 periods, that's extreme negative too. And then more in the intermediate term, we have the CMB composite and the speed of the VIX. It's going up because stocks are going down. It was extreme. Then we had one day on Wednesday when it was not. Now it's back to looking extreme again. So it's moving pretty quickly. And then the percent B, we actually closed down below the lower Bollinger Band. And I'll show you charts of all these things here. No change to the scenario right now as far as what's happening with the Fed. We'll see if Friday's report with core PCE ends up changing that at all. The dollar was up and interest rates were actually down here. Actually, this should be up. There's a mistake right here. We ticked up to 4.28, where we had been at 4.25. Now, the market doesn't seem to really be keying off of interest rates right now. Now, that's so last week. When we were dealing with that 4.5% level and we go below 4.5%, stocks would find some support. We went back above 4.5%, stocks would go down. Well, now the whole focus is shifted and it's more of a growth versus value because of growth concerns in the economy and inflationary concerns and all this uncertainty with all the tariffs and everything. So the stock market isn't really paying attention to that right now. And sentiment, we're getting all the way down to 18. Now, when we drop below 25, this is when we entertain the idea of using this as a contrarian indicator. We don't really have a lot of evidence that maybe we bottomed yet, other than we're seeing a lot of our short-term, excuse me, short-term indicators being extreme negative and quite a long list. But when we drop down to such a low level, that means there's so much pessimism out there that at some point maybe all the sellers are gone. But this could still, I mean, this 18, it could still go down from here, and we could actually stabilize for a day or two and then resume going down next week. And then we're also in a very weak time. February is the worst month of the year after an election. And it's certainly living up to that. And Friday's session doesn't have positive seasonality either. Then we're still back to looking inverted. This has been a couple of days now with the 10 to the 3 month yield curve. The 10 to the 2 year, that's not inverted yet or again. But the 10 to the 3 month is still inverted, and we're negative as far as the trend. The ADX is going up, it's above its moving average. That means the trend is getting stronger. Since it's above the moving average. We're still below 20, and that's that static number that I use to determine whether we're trending or not trending, but we're heading up higher. We're getting closer to that 20 level. And of course, since we had a down day, the bias, that's usually whether we have an up or a down day. That's negative, and then the last number of days taken together, that's the momentum, which is also negative. All right, then we had initial jobless claims, which were stronger than expected. This is showing economic weakness. It came in at 242,000. They expected 220,000. The continuing claims, not much of a change there, 1.867 million. And then the headline number for GDP for the fourth quarter of 2024, it came in as expected, and that was not a surprise at 2.3%, and also what we saw last time. But the deflator went up. It's at 2.4%, where last time it was at 2.2%, and that's what the market was expecting. And so that coming in higher was a little bit of a shock to the market. Then durable goods. These are bigger items that are purchased. A lot stronger than expected there at 3.1%. They expected 1.8%, where last time it was down 1.8%. When you take out transportation, it was unchanged, where they expected it to be up 0.4%. Last time it was up 0.1%. Pending home sales falling also, minus 4.6%. They expected it to be down a mere 0.8%. Last time it was down 4.1%. All right, here's some charts. Weekly jobless claims, where now we're going up with the claims and the moving average is starting to go back up too. That means that unemployment's starting to pick up. at least for folks that are filing initial first time claims. But we're still tending to go a little bit lower here with the continuing claims, even though the moving average is starting to tick back up. We haven't seen a real big change in that. We look for longer term trends with this. And then just to give it some context, now next week we'll get the new unemployment rate, but we're just kind of going sideways here with the continuing claims. We saw a real spike up with the initial claims, and then the current unemployment rate is at 4%. Then the real GDP and the deflator on a quarter over quarter basis, it's going down here a little bit with the blue line and up a little bit with the deflator. That's the inflation component, and that has the market a bit concerned. Year over year consumption is going up, so people are still consuming more things. And then the net exports, it's getting a little bit less negative than it was before. And then when we look over the year over year prospect here with real GDP, which means that takes inflation into account, it's positive, but it is coming down. And that's also suggesting economic weakness. Durable goods orders year over year, that really spiked up, but we've been chopping above and below zero now for quite some time. When you take out aircraft here, we actually declined a little bit, but it's still above zero. And then month over month, we saw a real pickup in durable goods orders. Year over year home sales still declining now. Now, some of this is because home prices have been really going up as interest rates have, and it's pricing people out of the market. Month over month, it's also declining as well. All right, then looking at the deviation of earnings, they're either above or below the long-term growth trend. When this is going up, because we should be right around this dashed line here, but we're getting kind of far away. And it's getting a little bit too far above the long-term growth trend. And you can see other times when this happened. This was the dot-com boom and then the dot-com bust. This was going into the great financial crisis, and you had real estate and everything happening. And then, of course, it was going up into 2021 with all the liquidity that was released into the economy. Well, we're pretty high right now, and this is causing some concerns. Then the average price move, the S&P 500 by days of the week, where in 2023 and 2024, Monday and Fridays were some of the better days. So far in 2025, this is not doing very well, and it doesn't bode all that well for Friday. Now, we could always buck the trend. Maybe we overdid it on Thursday, and we might see a bit of a bounce, or there could be more of a washout in what's happening as we further decline, especially with the late day selling that we're seeing. And the trailing quarter of net profit margins for when you take out the financials, Goldman Sachs still has this going up. And so that's still looking pretty good there. And then comparing things in Germany, that's the DAX with the S&P. It, things are going pretty well in the German market right now, and it's actually outperforming the US market as well. Okay, and then this is a correlation, trying to just chart these two together. Bitcoin's really come under some pressure. It's back into the 80,000s or so. It tries to get up over 100,000 and everybody cheers, and then it just kind of stops. And it can't seem to get much above that. Well, now we're seeing it pulling back as we're seeing the NASDAQ 100 under some pressure lately as well. And you might want to pause and look at this, but there's all this speculation going on of what are the tariffs going to do? And Goldman Sachs came out with this study here to think, okay, this is what the impact will be on that. And it's pure forecasting at this point. We don't even know if these tariffs are going to actually be implemented as they are announced. It might be more of a negotiating tool. And then the buybacks, we're seeing a lot of buybacks coming into the financials because that's been a stronger area. And then communication, which has been under pressure lately, but typically is one of the better performing areas. And even though healthcare has been under a lot of stress lately as far as price, there's a lot of buybacks there too. Now, maybe there it could be this idea that, well, if we announce we're going to do a buyback, maybe that will prop up our stocks. Hasn't really helped all that much to this point, with the least amount of buybacks happening in utilities right now. And then The takeaway from this is this red area down here. It's like, okay, if you have higher debt, that means interest rates are going to go up. Well, this study here just shows that's not necessarily true, that there's no positive correlation between the amount of debt that you have and what the interest rates are, and just compares all the different countries. All right, growth split into two parts in recent years: quality growth and unprofitable growth. Okay, and this is the Magnificent Seven and how it's been performing with the unprofitable tech. That's kind of interesting there, where it had been really outperforming, but going back to the summer of 2024, that was kind of the top, and then it started to lag. As we got into the end of 2024, it was really improving, and that's when we set the all-time high back in December. And there were a lot of hopes that it would do good in 2025 with this all this AI stuff going on and all these announcements about companies that are going to be investing billions of dollars into this stuff. It's not really coming through in price action here. Did spend some time on Twitter. I'm actually finding Grok kind of interesting, which this week seems to be the best AI tool. It'll be replaced by something else next week. It seems like every week. I understand, what is it? Chat GPT 4.5 came out. Now that's supposed to be the best thing. And then next week it'll be something else. And then China will come in and yeah, it's just an interesting area to follow these days. Okay, here's the intraday chart where we saw a little bit of buying going into the close on Wednesday, and then it looked like, okay, maybe we're going to get a nice little bounce here. And we did have a higher open, but then we couldn't get even up to R1 before the selling came in, took us down. We went all the way down to S1 really quickly. And then we came back up, and this is where we just kind of chopped above and below the unchanged level. Then you have the smart money coming in after lunch on the East Coast. And they're like, okay, we're going to sell. We're going to take this thing back down below S1, below S2, and then end up closing at the low for the day. And this also shows a real drop off here, and not much of a change in the initial overnight session that way. And this has now turned negative with the blue line below the red line on an intraday basis when we compare growth versus value at the large cap level. And this is also dropping below, we're falling off here, but we're going below the low that was set at the end of January. And then we were seeing this nice little run up. Now, starting at about the 18th of February, we've been really declining with the growth to value ratio here. Then we look at the end of day charts and you see growth just got hammered down 2.57%, where value was down just a mere 0.46%, and growth was down more with the mid caps and with the small caps. And this is not what you want to see when the underlying um, attitude of the market is more positive. We're seeing these going down. Now, this is still in an uptrend longer term, but we have been really seeing some weakness here. And we're seeing weakness here with the mid caps, and we're also seeing some weakness, but holding up a bit better with the S&P growth to value ratio. And we're coming down. We'll see if we get some kind of support here. We compare a growth versus a value ETF. We're coming down to the 250-day moving average. Now, we have dropped below that before. So if that happens, it doesn't necessarily mean all is lost, but there are other times when we came just about down to this level and then bounced up off of that. But we're trying to evaluate this on a day by day basis. Are we shifting over and becoming more defensive, or is this more or less just some profit taking and to try to scare the weak hands out of the market before it gets set to go higher? And you can make a case for either side at this point. And then we're seeing more weakness again when we look at discretionary versus staples. And we are coming back up a little bit here with the staples because they had really shot up and then it came down and went back up. And so the ratio is actually going down. And it's not that we're seeing an awful lot of weakness in discretionary. It's been more of recent strength in staples that's driving this ratio down in the short term, but longer term, it's still in an uptrend. Large cap growth below its 100-day moving average. Are we going to go down and get close, if not to the 200-day moving average? We were down 2.5% here. And here's the trend. We're going up with the ADX above the moving average. We're still below 20, but the red line's going up, the green line's going down. So this is an intermediate term negative trend. But we don't really call it a trend until it goes above 20, but it is getting stronger. And we're going up as well in the short term. So short and intermediate term, the trend is also negative. We were above average with volume, and we're seeing the Ulcer Index, a sentiment gauge, that's going back above the moving average. So that's showing fear coming into the market here. And this is another thing that's a concern. We're back above 20. Actually, shouldn't say back above. For the first time in quite a while, we're above 20 with the VIX. And the VIX of the VIX is also going up. And that's usually what happens when the VIX goes up. The VIX of the VIX also goes up. And we're above 70 here, meaning that we've climbed pretty far, pretty fast with the VIX, and then measuring the momentum using an RSI based on 9 periods. The momentum, as measured by the MACD, is also up. And this is research put out by Tom Bally, who's connected to stockcharts.com and earningsbeats.com. Now, the data is about a year old, in fact, a little bit longer than that. But the idea is the same, is that when we're below 20 with the VIX, that's when we see positive annualized returns. And the further down we go with the VIX, the better those returns are. Now we're coming up into this red area where we're above 20, and this is when we see negative annualized returns. And so this is producing more fear in the market right now and more selling. We're coming down with the skew index, but we're still in this red area now. And we're going up with this fear gauge as well as the other fear gauge. We've been seeing some contradiction there. Now they're confirming each other. And we did get the latest reading from the American Association of Individual Investors. Now, this could actually be positive for the market because they're extreme negative right now. And individual investors, which includes you and I, we tend to follow what's already happened. And they're reacting, and this is about a week old now, and it may even become more negative, especially if we have a negative close on Friday. It's probably going to get even more pessimistic here. And this is another sentiment gauge that we look at when we really drop down to a low level. That's when we entertain the idea of using this as a contrarian indicator. And we're going down with the risk on to risk off ratio. And this is just showing the weakness that we're seeing in the market. We're going up with the equity put call ratio, daily chart, the 5-day chart, and the 10-day chart. All of those are going up, and that's more negative. And we actually ticked down a little bit here, but we're above the band when we look at volatility risk premium. And the advanced decline line, it's declining here based on price and volume, a little bit more intensity based on volume, but it's not falling off a cliff. Now, this could be the rest of the stocks in the S&P that are seeing some buying, where the big stocks that really control the value of the index itself, that's where we're seeing a lot of the weakness right now. And we actually ticked up a little bit and we're above zero with the advancers minus decliners over the last 10 days. This is showing some internal strength, which may be value related instead of growth related. And you look at the new highs, new lows, we're falling back with the new highs, a little bit of an expansion of the new lows, but we're still going up with the 5-day. The 10-day chart's still kind of going up right now. So internally, we're still seeing strength inside of the S&P, but it may not be the growth areas. And we're starting to fall below the midpoint here with our short-term advanced decline ratio. And we're coming down to the moving average. This is smart money indicator number one. The context is that, yes, we've been declining, but we're still above this moving average. This will officially turn negative if we fall below the red line, which is the moving average. And we're also negative and crossing below the midpoint with the Chaikin oscillator, and we're declining with the Chaikin money flow. The red line's going down, the histogram's going down. It'll officially turn negative if we keep going down and these turn red. And the vortex has the red line going up and the green line going down. This is negative, but we're not seeing that much of a change with the advanced decline line studies that we look at. Coming down a bit here based on volume on a cumulative basis, but based on price, we're just kind of chopping along sideways. That could be because the stocks that have been out of favor are going up, where the stocks that have been in favor are going down. and they're kind of canceling each other out. But the stocks that are going down right now usually see lot more volume, and that's why this could be leading things lower. And we're dropping below the moving average here with the cumulative advanced decline line for the NYSE, but not really showing an awful lot of weakness here. We're still above the moving average with the regular advanced decline line, and kind of the same thing here, declining, but we're still above the moving average with this other NYSE advanced decline line. We break it out based on a common stock on price. We're going down there. We're also going down based on volume, but not necessarily falling off a cliff, although it is negative. And we're below the moving average with the common stock with our advanced decline line studies. We're declining, but still above the moving average with the S&P, but it's the mid caps and small caps that are showing more weakness. And we're dropping below zero with the NYSE, new highs, new lows. The black bar, the bars that you see here, those are the daily readings. The red line is a 50 period moving average, and that's just coming down. It's weakening, but it hasn't quite crossed below zero yet. Then we look at another broad market measure of the 5 period moving average of the highs and lows, and we are below zero. We're below 50 and declining with those stocks in the S&P above their 20-period moving averages. This is more short-term weakness. We're dropping slightly below 50 with the 50-period moving average study. We're below 50 with the 100-period moving average study. We're declining but still above 50 with the 200-period moving average study. So in the short term, and I've been pointing this out here, we're getting ready for March to happen, and that's why the pivot points are on here already. And we were above average with volume. And we declined with the 20, 50, and 200 period moving averages on the S&P itself. And this is the rate of change going back 5 periods. We're starting to get an extreme reading here. Now, this was the end of the world days that happened here, and then we bounced up out of that. Is something similar going to happen this time? Now, we could still go further with this particular indicator, though. But then we look at the momentum on a short-term basis. The Stochc RSI is extreme negative, as is the Williams percent R, CCI 14 and 20. The short and intermediate term stochastics, those are extreme negative, and we're crossing below the midpoint with the longer short-term version. And again, I like to point this out. This chart is a further subdivision of the short-term time frame. And we're getting extreme here with the force index hitting the lower Keltner band. And we're getting a little far away from the 20-period moving average. We use the boom indicator here, and this works like an oscillator. And we're dropping down and getting kind of far away there, turning more negative in the intermediate term, but not extreme. And we're also declining with the 200-period moving average study. This is a condition of the short-term trend. We're going down with the green line and the blue line. And that's not surprising. And we're below the simple and exponential moving averages. That's what turned the short term to negative. We're in the -3 channel with our standard deviations chart, and we're dropping below the midpoint with the balance of power. That's turning more negative now. We're extreme with the CMB composite. I use this like an oscillator. The go, no go, you can see no go purple. This is definitely negative. We're hitting the lowest low value. We're actually exceeding the red line here. That's turning more negative. And we fell below this short-term anchored moving average. We fell below a little bit longer term, the purple line. Now we're wondering, are we going to come up to this next line? So we're seeing some real weakness here. Now, longer term, these lines are still going up, and so that's positive. And we're still seeing more weakness here with the TTM squeeze. We're moving kind of quickly now with our standard deviations chart. As we've been coming down, it's picking up that fast movement. We're below zero and declining with the ease of movement. We're below zero and declining with the Arun indicator. We're below zero and declining with the S&P McClellan oscillator. So we're going down based on price with the summation index and going down with a little bit more velocity based on volume. But both of them are declining, so this is negative. We're below zero and declining with the NYSE McClellan oscillator, so we're going down with the summation index based on price and volume. Below zero and declining with the Swanland trending oscillator based on price and volume. A little bit more intensity here based on volume. Momentum is negative. The PMO is going down below the moving average based on price, and now we've really crossed below the moving average here based on volume. So we're declining with the PMOs that are rising, the buy signals are declining, and we're tapering off to trying to flatten out here with those PMOs above zero. Momentum in the short term is negative with the slope oscillator, more short to intermediate term with the MACD, that's negative. All of our momentum oscillators are negative in the short, intermediate, and long term. And another momentum oscillator is the Copic curve, which is also negative. We're going down with the Sean trend meter. We're dropping below 50 with the money flow. We're below 50 and declining with the ultimate oscillator. And we're still above the moving average here with unbalanced volume. We'll see if that ends up providing some kind of support. And we went down pretty fast. We closed down below the lower Bollinger Band. That's where we're getting an extreme reading with the percent B indicator. And we're extreme in the short term with the RSI, extreme negative, where we're just declining with the RSI 14. And we're negative with the Elder's Impulse System for the S&P. The parabolic SAR is negative. The condition of the intermediate term trend is weakening as the blue line and the red line are now declining. We're below the 50 period simple and exponential moving averages, and we broke below the 100 period moving average. I was really harping on this because if you look back to January, we came right down to this. We broke down below it, but then closed above it, and then we closed above it again, and then we launched up out of that. This time, that's not happening. We've broken below and closed below the 100 period moving average. So we'll have to see. Now, there's some other moving averages you could put in here 120 days, 108 and a half days, whatever you want to do. The next moving average that I follow here is the 200 period moving average, and that's the long-term trend. And we're dropping below 50 and declining with the bullish percent index for the S&P. The NYSE bullish percent index is declining and negative, and we dropped below 50 with the Nasdaq 100 bullish percent index. And we're dropping below the Ichimoku cloud here, and we're turning more negative with the studies that are put on here. The green line is dropping, the blue line is starting to drop below the red line. And this, in my opinion, is what was causing a lot of the problem. A long-term trend channel going back to 2009. We just were not able to break above that. And we're negative with the Heiken Ashi. We're negative with the Kegi chart, negative with the Renko chart, negative with the three-line break chart. And we dropped enough to add another O in here. And now we have a double bottom breakdown as far as what the point and figure chart is coming up with. When there's zeros in here, that means declines. Long term, seeing some weakness with the 150 and 200 period moving averages. And we're negative across the board in the short term, and we're even more negative in the intermediate term with the mid caps and the small caps. And bonds are positive in the short and intermediate term based on price. Commodities have switched over to negative in the short term, and the dollar's been under pressure in the short and intermediate term. And you see the areas, financials, they were up. That was the strongest area, and we like that. And energy and real estate, these are tend to be more defensive areas, depending on how you look at that. But you can see tech got hit the hardest, discretionary communication. These are the three big growth areas, and those are the ones that got hit the hardest. And some green or blue to start out the day, with the NASDAQ being above 19.2, then 19.1. And then everything turned terrible after that. The NASDAQ got below 19,000, 18.9, 18.8, 18.7, 18.6. It's like a countdown to a blast off here. And then the S&P broke below 5,900. Earlier in the day, we had the BPI cross below 50, and I showed that chart. And then the tech sector had a BPI cross below 50. So yeah, we're seeing some weakness here. And we're going down with the equal weight as well as the weighted version of the S&P. We're going down with the ratio as the weighted version of the S&P is underperforming the equal weight version. And that also is this growth to value play that we're seeing. And still below the 50-day moving average. The Dow actually held up the best. It was down a mere 0.46%, but it's still negative when we look at the diamonds using the Elder's Impulse system. The NASDAQ got hit 2.78%. Could it come down and test its 200-day moving average? Down 2.75% with the NASDAQ 100. Could it come down and test its 200-day moving average? And we're declining with the QQQs with the Elder's Impulse system. The momentum for the NASDAQ 100 is negative. Small caps falling further below their 200-day moving average with the S&P 600. And small caps are negative here with the Elder's Impulse system. And then we look at the Russell 2000 small caps. We're starting to get extreme here with the RSI, but we're below the 200-day moving average, and the momentum is clearly negative. Mid caps falling below their 200-day moving average. This had been holding up fairly well here. We lost that support on Thursday, and we went from neutral to negative with the Elder's Impulse system for the mid caps. Further declines here with the Wilshire 5000, a broad market measure, also down below its 50-day moving average with the total US stock ETF. And we're spiking up here. Staples on a short-term basis are outperforming the tech sector. This is also showing us that the market is getting more defensive. Financial sector was up over 0.5%. So that's encouraging. We want the financial sector to do well. That just means that things aren't falling apart in that area. The FANG index down almost 3.5%, still in a longer term uptrend, but below its 50-day moving average. Amazon down 2.62%. Apple down 1.27%, dropping below its 50-day moving average. Microsoft, which they made this big announcement with all this investing that they're doing for technology, but I've also been doing a little bit of research on this, and they seem to be kind of behind with the whole AI thing. And maybe that's why the stock's having a little bit of problem here, and we're actually starting to see a death cross. Google dropping further below its 200-day moving average. Meta coming down to its 50-day moving average. It's actually holding up a bit better than the other mega caps. And Nvidia down 8.5%, dropping below its 200-day moving average, possibly in a bear market now. And Tesla coming down and testing its 200-day moving average also. Real weakness here. Going back to the end of 2024, it's just been on pretty much a straight downward move for 2025. Netflix down 2.73%, still hasn't come down to its 50-day moving average. And then I wanted to show the semiconductors. We're dropping below the rainbow now. This is a huge part of the tech sector, and with these showing weakness, this is not a good sign right now. We need to see this turn back up to gain some of this confidence back in the tech sector itself. And we're really seeing a drop off in the short term correlation as world stocks have been holding up better than US stocks. And we're seeing the correlation dropping down a little bit in the long term as well. Oil did tick back up. We're getting back up into the 70 range. The dollar is still in a longer term uptrend, and it was actually up in Thursday's session, and that probably pressured stocks as well. We're going back up a little bit. We're dealing with the 200-day moving average here with the 10-year yield. And if we could drop below that, that would be more positive for interest rates. That might happen on Friday, or we could continue to go up if the core PCE is not taken as friendly. And we're coming down here a bit with the 10-year based on price. This is where we're back to being inverted again with the 10 to the 3 month. As I said before, the 10 to the 2 year is not inverted, but the 10 to the 3 month is. And then we're showing a lot of weakness here with our growth to value ratios. Down with the Qs to S&P, down with discretionary to S&P, down when we compare large cap growth to value. And we're down with the large caps, mid caps, and small cap growth to value ratios. Not a real positive sign right now. And this is also going up. Staples are spiking when compared to the S&P 500. Now, the overall trend has been down, but are we starting to see a shift here? And we don't really know. We're just going to have to let this draw out a little bit more, but it looks like it could be developing into that. So what's the outlook? We are negative in the short and intermediate term, and we've just kind of began the early stages of this trend. We're going to get the advanced international trade in goods, wholesale, and retail inventories, not really influential. Personal income and spending, with the big one being the core PCE, and then the Chicago PMI is going to come out, and we'll get pending home sales. And then anything else, geopolitical, what's going on with the administration, the Epstein list. There's all kinds of crazy things to focus on these days. And then here is finishing out the calendar for the economic reports. And I didn't shift this down here. We should be focused in the Friday area. Seasonality is not good for the last day of February. We're negative with the Dow, S&P, and NASDAQ. Now, we could always buck the trend. These aren't 100% down or these aren't zero. So it means there are some up days in here. Okay, and then finishing out the month of February, whether it's a regular year or a post-election year, historically has been a weak time. And we're finishing out the second half of February, which tends to underperform, and it's really lived up to that this year. Also, seeing some weakness going into the latter part of February. February is the worst performing month after an election. We see that on this chart as well as the next chart. And then we're looking negative with our three smart money indicators, and not necessarily extreme with those because they were actually quite positive, and now they've been shifting over and looking more negative. And we're going up with our 5 and 10-day equity put call ratio charts. And we're negative with the McClellan oscillators and summation indexes for the S&P and NYSE. Parabolic SAR, the swollen trading oscillator, the bullish percent indexes. The momentum for the S&P is negative, including the Copic curve. Ease of movement, money flow, those are negative now. The ultimate oscillator is also negative. The vortex is negative, and the momentum for the Nasdaq 100 is negative. Now on the positive side, now longer term, when you look at those growth to value charts, the end of day ones, we're still in uptrends, but we're seeing some real short-term weakness now. And discretionary to staples, longer term, still looking okay, but some real short-term weakness. And then some of the other studies that we look at, like near the end of the video that I showed the growth to value ratios, those are clearly declining and looking negative. The advanced decline line is still positive for the S&P, but we're seeing weakness in the other areas of the market. Financial sector is still positive as well. So our conclusion, we're negative in the short and intermediate term. We're still positive in the long term. In the short term, you could say we're becoming oversold, or there might still be some more room to the downside for this. In the intermediate term, we're below the 100 period moving average. Are we becoming oversold? And then we're still positive in the long term. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.